Microcaps. A lot of potential, but loads of high-risk garbage. I'm going to share with you my fundamental system for screening microcaps, which you can then build off. Now there's two basic elements to my microcap system. One, we want to remove the high-risk junk, and then two, we want to look for cheap stocks. If you only focus on cheap, it's probably that you're going to be buying $5 Rolexes in the back of some alley and you're going to be getting shilled. If you only remove the high risk, well, this can help. It will definitely increase your returns, but there may not be that big oomph for upside potential. Now, the platform that I've been using since 2011 is Portfolio 123, and it is amazing. No coding, fact-check data. It's a toolkit that's usually reserved for hedge funds. So here's the basic setup. No over-the-counter stocks, maximum of 20 stocks, although I'll show you later how this works across our entire universe. And we're going to be rebalancing every week. Into the rule section, I start with my size and liquidity filters. The stock has to be smaller than 1 billion market cap. The median daily turnover is $50,000 minimum, and the price has to be above $1 per share. So to remove junk, there's a two-step process. The first one is that I want the stock to be profitable. You can use earnings per share, but I use free cash flow. It's positive over the trailing quarter and over the trailing 12 months. What I don't want is a story stock where they claim to be the next Amazon. They're fantastic, but they can never seem to turn a profit, and they keep talking up their stock and then taking on more debt or diluting shareholders. The second aspect is to look for low short interest. This is kind of a shortcut where I rely on other people to tell me what's risky. Higher short interest means there is risk potential. I want cheap stocks, but I want them cheap not because there's some massive scary event looming on the horizon, which could go either way. Now, when it comes to my value factor, I keep it really simple for microcaps. Low price to sales over the trailing 12 months. Do I have a specific number that I'm looking for? No. What I do is I first filter out all the higher risk names, as I showed you in the rule section, and then I just keep the top 20 or so stocks using low price to sales. That's it. Let's look at the performance. Backtest, run backtest. All right, now here's the gross performance over the past 20 years. As you can see, it beats the Russell Microcap ETF IWC by roughly 30% per year. Of course, this is gross returns, and we're going to have to control for slippage, and we're going to go on to make this even better, but this is just to give you a rough idea at this point. Now, to analyze this a little bit more in depth, I took the rules listed here, my liquidity, my free cash flow, and my short interest, and I made that into its own universe. So only these stocks will be analyzed. And I'm going to run, as you can see the chart here, I've run the price to sales factor across my low risk universe. Now this chart is comparing the return versus the benchmark. What does all this mean? In my low risk universe, very high price to sales ratio stocks, the ones I don't want, they perform about as well as the index. And my lowest price to sale stocks, as shown in this sub-portfolio, they outperform the index by about 32% per year. So that's it. There's so much more you can do with this. This is just a start, but I've made this screen available to you in the comment section, and I encourage you to try out Portfolio 123. It's been an amazing tool for me, and I'm sure it will be for you too.